Recently, Norinchukin Bank, Japan's fifth-largest bank, announced plans to sell over 10 trillion yen in U.S. Treasury bonds and European sovereign bonds to cover substantial unrealized losses. The root of the issue lies in Norinchukin's overly optimistic misjudgment of the Federal Reserve's rate hike cycle's intensity and duration. This miscalculation led to a continued depreciation in the value of high-priced foreign bonds purchased in the past. During this period, the bank failed to implement effective risk management, resulting in a sharp increase in unrealized losses. With the bond sale, it is projected that by the fiscal year ending March 2025, the net loss will rise to 1.7 trillion yen, more than triple the amount during the 2008 financial crisis. Norinchukin holds 20% of Japan's foreign bonds, and its massive U.S. Treasury bond sell-off could trigger a domino effect, impacting other institutions and retail investors. As Japan is the largest holder of U.S. Treasuries, will this local sell-off lead to a fire sale of U.S. debt? Unlike major banks such as Mitsubishi, Norinchukin's loan business is much smaller, and it lacks an investment banking division. The bank primarily relies on securities investment portfolios for profit, with current asset management totaling $840 billion. Benefiting from Japan's negative interest rate environment, Norinchukin can finance at extremely low costs and then invest the raised funds in U.S. Treasuries. According to the Bank of Japan, as of the end of March, deposit-taking financial institutions held 117 trillion yen in foreign debt, with Norinchukin accounting for about 20% of this amount. Besides bond investments, Norinchukin is also a major global player in collateralized loan obligations, CLOs. However, even these professional players frequently make significant mistakes. According to documents released by Norinchukin last month, as of March this year, the bank's 31.3 trillion yen in bond holdings accounted for approximately 56% of its overall investment portfolio. In 2023, Norinchukin reduced its bond holdings by about a quarter, mainly to alleviate the pressure from Federal Reserve rate hikes. However, by March this year, Norinchukin had replenished its bond holdings, reaching 31.3 trillion yen, indicating they were betting on the US and Europe initiating rate cuts soon. Early this year, the market optimistically believed that the Federal Reserve might start cutting rates as early as March, with 5 to 6 rate cuts expected throughout the year. However, reality dealt a heavy blow to these optimists, as economic data repeatedly fell short of expectations, causing the Fed to delay rate cuts. As time passed, the losses on Norinchukin's heavy investments in U.S. Treasuries grew. By March this year, losses on bonds had reached 2.19 trillion yen, with net losses expanding to 1.76 trillion yen. Last month, Norinchukin announced a comprehensive plan to adjust its investment portfolio, finally declaring a need to cut losses on bond investments a few days ago. Norinchukin's CEO Kazuto Oku stated in an interview, "We plan to sell 10 trillion yen, approximately $63 billion, or more of low-interest foreign bonds, acknowledging the necessity of significantly changing our portfolio management to reduce unrealized bond losses." As of the end of March, the total unrealized bond losses amounted to 2.2 trillion yen. Additionally, the Bank of Japan's first rate hike in decades this March also dealt a double blow to banks holding overseas bonds. It is well known that Japan is the largest holder of U.S. Treasuries. According to the U.S. Treasury Department, as of March, Japanese investors held $1.18 trillion in U.S. Treasuries, the largest share among foreign investors. On the other hand, the Federal Deposit Insurance Corporation, FDIC, reported that U.S. banks' unrealized losses in the first quarter totaled $516.5 billion, up from the previous quarter. If the Federal Reserve's decisions in the coming months continue to fall short of market expectations, it is highly likely that more banks will face significant losses, potentially triggering a series of chain reactions.